Rich people not only know how to make money, they know how to keep that money and use leverage in order to make more money. And this is how you can do the same. So I'm going to use an analogy for this video. You know, when you go to the gym and you see a lot of people working out, but their diets don't necessarily match that fitness activity. So the results that they're trying to achieve really just isn't there. They're not necessarily losing weight or they're not necessarily getting stronger. Well, it's because they're forgetting the second part of the equation, which is diet. Money works in the same way. If you're looking to get rich, and if that is your goal, you not only need to earn more or make more, but you also need to look at the second part of the equation of what are all the different factors that can take that money away? And what are the missed opportunities that are hindering your ability to make that achieve that wealth? So when we're looking at money, let's say that you put your money into a savings account that's accruing anywhere between 4 to 8% interest a year, but if something like taxes is taking it away, or something like your expenses is taken away, then you're not really netting that 48%. It's significantly lower than that. So in this video, we're going to talk about not only, okay, you understand the concept of how to make more money and earn more money. We're going to look at the second part of the equation. How do rich people not only know how to make money, but what are the strategies for that second part of the equation that mitigate taxes? And how do they use things like debt an advanced technique in order to get even richer? So let's go over that right now. So, first things first, let's talk about how you can strategize your money so that you are able to keep more. Now, I specialize in cash value life insurance policies, but as you do your research on what all are the other tools that you have available to you, just know that cash value life insurance policies are just one common methodology that wealthy people use in order to keep more of their earnings. Okay. So let's go back to that example. Let's say that you have your money in a high interest yield savings account at the bank and it's accruing about 4%. Okay. Don't forget that accumulation at the end of the year, let's say whatever money that you get based on that 4% interest, it is considered taxable. The IRS does consider that as taxable income. Now, knowing that, a lot of wealthy people will not keep their money in a high interest yield savings account, but rather move that money over to a different financial vehicle. Okay, whether it be an account, whether it be an investment, where they know their deposits are still growing at a comparative interest rate, but the whole intention is to mitigate the tax implication. And one methodology is to move that money and put it into a cash value life insurance policy. That is why it is very common for wealthy people to have life insurance. Not necessarily for that coverage, but because there's two components in a policy. There's going to be the cash value, which operates just like a high interest savings account, growing anywhere between about like 5, 10, 12%. It really does depend on the structure of the policy. Now, there's also going to be that second component, which is going to be the death benefit. And death benefit is commonly known as that lump sum of money that gets passed on to your beneficiaries after you pass away. So there's going to be two important components of that policy. Now, I just told you about the growth. It could range anywhere between about like 5, 10, 12%, depending on the structure of it. Now, as the policy owner continues to make those premium payments, okay, a lot of those premium payments will go into both components, okay, and both of them are growing, but the growth in this cash value is going to be tax deferred. Okay, you don't have to report that growth on your IRS when you do your filing. Okay, it's going to be tax deferred. Now that's going to be great and all, but really the juiciness of it is that you want to be able to, excuse me, you want to be able to access those funds, right? So how do you do that? If you withdraw from the cash value, that is going to be a taxable event, just as if you were doing that at a bank. So what a lot of people do is, knowing that they want to capitalize on that limitation on taxes, they will borrow against that policy through a loan, and now they are able to access that cash component. So let's go backtrack. That was a lot of information. If you leave your money in a high interest savings account at a bank accruing at 4%, that growth is going to be considered taxable. If you have money in a cash value life insurance policy and you put that into the cash value component of that policy, that money is tax deferred and you can access those funds tax free, just like if you were to do it at a bank. So, same money, comparable growth, totally different tax strategy. Now, the second reason, and a very important reason that gives wealthy people a leg up, is that this is an advanced strategy. Knowing that if you leave your money at the bank, it can accrue at 4%, but it is taxable. So many wealthy people will use the cash value component in order to grow their money. Okay. The important IRS distinction is that the IRS will consider life insurance policies as insurance. Therefore, they do not get treated the same way as other taxable investment accounts. Savings accounts is not considered necessarily as income in the traditional sense. The IRS considers life insurance policies as insurance, well, because it's the only financial vehicle that has a death benefit. That makes sense, right? So, what wealthy people will use, and this is an advanced strategy that is available to you, if you know the cash value component grows at a certain rate and you are able to access those funds by borrowing against the policy, not withdrawing, borrowing against the policy, what essentially means that you're taking a loan out against your own policy. You own it. You're essentially your own bank, okay? Let's say that you take out about 20,000 out of that insurance policy. Well, you call your insurance company and say you want to borrow about 20,000. Okay, what they're going to do is they're going to do the math for you, and they're going to take a look at, do you have enough in death benefit and in cash value in order to warrant that amount? And for the most part, they'll guide you through the process. They may, at a certain point say, you may not have it now, but you will have it, in a couple months or something like that. They're going to do the math for you. Whatever. Just understand the thought process. So they're going to take a look at that, and what they will do is basically loan you out that money. It's your own money, so you don't have to go through this entire application process, okay? Now, what they will do, where did that money come from? Instead of taking out of the cash value component, they're going to take a look at your death benefit, and they'll collateralize a portion of that death benefit, decrease that, and take that money out and loan it out to you. Now, typically, the loan interest is going to be simple interest, anywhere between 5, 7, 8%, and therefore you have this money. Now, wealthy people will use this money in order to use it as leverage. What they will do is purchase or invest that money into some other financial vehicle where the returns are greater than that simple interest. So they'll buy that rental property, or they'll invest into a friend's business, or they will buy that commercial building where the profit is, they're getting a return about, 12, 15%. So what they will do is use a portion of that profit to pay that loan back, and they pocket the difference. And that's how they make more money. So by doing that, they put it back into their death benefit and their policy. And when the time comes or they need an additional fund, they call their insurance company and say, run the math. Can they take out another 20,000 or something? And then they'll go purchase another asset, invest that, and then it becomes the cycle. That thought process. This is called the you can you'll hear different terms. They're called premium finance or infinite banking. And so a lot of wealthy people will not only use cash value life insurance policies, not over the savings component and obviously the coverage, but because of this whole cycle, this becomes an opportunity for them to be their own bank. Now, it is pretty advanced. Now, can you do this on your own? If you get a cash value life insurance policy, 100% yes, you can. So, if that opportunity is enticing for you and like, oh, okay, actually, I never thought of it that way. Yes, it is a good idea. However, I want to add this caveat. This isn't the only way in order to create wealth, but do have this in your back pocket, because as you progress in your wealth accumulation strategies and your saving strategies, it is nice to have a well structured toolkit of all the different opportunities that you have available to you. Because if you have an opportunity that'll come up and you need some quick access to cash, here's your cash value life insurance policy. You might as well capitalize on that. Now, the third and the last component of why wealthy people will opt for cash value life insurance policies is, now that we talked about the savings, we talked about leverage. Now, the third component is, we're all going to get old, okay? And at some point, we're all going to retire at some point. So if you understand the ability to take loans out from that policy, I should also mention that when you take loans out against that policy, they're going to collateralize that death benefit, right? The cash value component will still continue to grow. Okay, it's still going to compound as if you never touched it, because really you didn't touch it. And that's the beauty of it. If you were to do a withdrawal, just like at a bank, your balance will actually decrease. But because they're collateralizing the death benefit number is going to change. But the cash value component doesn't. It continues to grow. And again, when wealthy people will take this strategy in order to finance their new investments or continue to grow their investment portfolio, their money is growing technically in two places. One, in the value of that asset or investment, as well as the cash value component. Now, let's talk about retirement because at some point we all want to stop working, right? So, oftentimes, wealthy people will use their cash value life insurance policy as one of many sources of income. Okay, not their primary source of retirement income. Again, when there's going to be this best practice, you should always try to have about 7 sources of income, and cash value life insurance can be one of them in your retirement years. So let's say that we have this wealthy person, they were utilizing that in order to create their investment portfolio, and now they have multiple sources of income. Well, they still have the cash value life insurance policy, and let's say they take a loan out, let's say for another 20,000, but they don't purchase that asset, that investment, and they just want to use it to pay down their debts, or they want to, they just want living expenses or pay for medical or whatever. I'm just making this up. But they can oftentimes use that as retirement income, tax free. Remember, taking a loan out and borrowing against a policy is not a taxable event according to the IRS. There's interest to pay back to the insurance policy, but it's not considered income. It's considered a loan. Now, depending on the compounded trajectory of both of them, oftentimes wealthy people have had that life insurance policy for so long that they can afford to do that without having any serious negative impact on the growth of their death benefit and their cash value component of their insurance policy. So if you get a cash value life insurance policy and it's well structured and it's well funded at the very beginning and let that ride over several decades, yes, it is very common to use cash value life insurance policies as a form of retirement. Not the only one. Again, I have to keep repeating that because I'll probably get some comments about that, but it can serve as one of the 7 sources of income during that time. So the reason I wanted to share these 3 very, very important steps is if you're in this video, you're probably looking for different ways in order to get rich, okay? But many people will limit their knowledge in how to make more money, okay? How can you make money really fast? How can you grow that money? But oftentimes I will come across people who will almost always forget that second part of the equation because it's not as sensationalized, and it's really kind of boring because again, as the topic is about taxes and it talks about numbers and compound growth, and sometimes it can get a little technical, but I can't stress enough that if you are constantly working out and lifting weights and doing all these things at the gym but you have a shitty diet, you're not going to achieve the results, and if you do, it's not going to be at the rate that you want. So if you're always going to be focusing on how I can make more money with disregard to all of the different elements of the equation that take that money away, you're not going to achieve the same results. So let's review. You won't, generally speaking, you know how to make more money. So step 1, figure out the different tax strategies in order to mitigate that risk, to mitigate any liabilities. Cash value life insurance policies can help you in that, okay? It's not the only way, but it is a very clear way. And again, I specialize in that. Use cash value life insurance policies as leverage in order to grow your investment portfolio. And the third, think long term and how else can you use this policy for retirement purposes. So 3 different strategies all in one well-structured policy. Now, use the information that you just learned as a tool in your toolkit as you start growing your wealth. If you have any questions about what we just talked about and how the numbers specifically work out for you, go ahead and click the link below. I offer you a free guide and we'll explain how you can achieve financial freedom.